Welcome back, friends. In our second session, I hope you all enjoyed the delicious spread by Goldfinch Hotel. Before we start the second session, I request all of you to please stand up for our deputy past anniversary who has passed away on 11th November. CA Anamban sir. Please stand up and for 2 minutes. Om Shanti, Shanti, Shanti. Thank you, friend. Our second speaker for the day, CA Jagannathan, who will enlighten us about the key consideration in corporate restructuring via merging and acquisition. To give a formal introduction, I call upon our coordinator and very senior CA, Hemant Gandhi. Please.
Good morning again. First of all, let us welcome today's learned speaker, Sri Jagannath ji, CA Jagannath ji, and who will be taking up with the topic of merger and acquisition, corporate restructure. For that, he has given his valuable time and come all over on Sunday. So please applause with loud applause. Welcome him with loud applause. Now I will just give you a brief introduction of Mr. Jagannath ji. He is a more than 15 years of experience in domestic and international tax, merger and acquisition tax, deal advisory, buy and sell side, corporate restructuring, due diligence and regulatory advisory. He is a chartered accountant and a commerce graduate. He is the founding partner of Kritha Sapphire Advisor LLP, a boutique tax consulting firm. Earlier, he was associated as director with KPMG Deal Advisory, M&A and PE practice for over a decade. He has worked across sectors like pharma, financial services, fintech, FMCG, automobile, telecom, infrastructure and real estate. He has advised large listed and unlisted groups in pre-funding transaction structuring, buy and sell side structuring, due diligence, review of transaction documents, cross-border merger advisory and transaction implementation. He has also advised various MNCs in the areas of corporate and international tax, direct tax litigation, compliances and cross-border taxation and regulatory matters under FEMA, SEBI, Companies Act, Stamp Duty, etc. Also, he has engaged with startups in their exercise of international and externalization of their group holding structure. So we welcome him And before we invite him, I asked Sri Rajendra ji, CA Sri Rajendra ji, please come and have a memento. So please come, Mr. Jagannathan ji, and share your expertise knowledge on the topic. Thank you, sir.
Good morning, all. Thank you, JB Nagar CP Study Circle for this opportunity. I thank the convener, deputy convener, and the coordinators for giving me this opportunity. Today's topic is on M&A tax. So it's a very interesting topic as such. So a lot of deals are happening these days, not only in the large sectors, large companies, but also in the SME sectors. So even in the smaller companies, because the way the Indian economy is growing, there are many so companies which have come over the last 10 years who would like to sort of who had the intention to sort of grow beyond so their usual territory and so their usual business. So in today's topic, we'll sort of cover the various M&A modes, the drivers, consideration framework for the M&A deals, and the corporate restructuring. We'll also deal with some of the basic concepts of merger, demerger, slump sale. We'll also touch upon briefly on the capital reorganization, on the capital reduction, buyback. We'll also talk about the transfer of shares within the group. And then we'll take a few case studies. On this slide, I've summarized the various modes of M&A. So broadly speaking, we have merger amalgamation, a demerger. These are situations where, for example, if a large company, if they want to sort of acquire another company and then sort of merge with themselves, or there are a group of companies with multiple businesses and they want to merge all the businesses together. Some of the prominent examples are, so in the space of demerger, for example, we have a classical case of Bajaj, wherein so earlier sort of two-wheeler segment and the finance segment was together. They have sort of demerged that and created huge value for the stakeholders and as well as for the promoters. In terms of merger, there is a case of, for example, Suven Pharma, which is merging with another unlisted company, Cohen Science. So the idea there for the shareholder is to sort of create a larger platform for the CDMO play, which they would like to scale up very fast. So this is a classical case wherein you have a listed company merging with a unlisted company and creating a larger company. The next is the acquisition. So broadly speaking, acquisition, the company does in the form of, say, a share purchase, or it could be done by way of a slump sale or an itemized sale. Now, this is a very intriguing question whenever there is an acquisition as to whether you would like to sort of acquire the company per se, that is by acquiring the shares of the company, or would you sort of acquire the business per se? Now, both has its own pros and cons, both from the buyer as well as from the seller side. We'll cover that topic little later. In terms of capital reorganization, we have buyback and capital reduction. Buyback, as you would know, a lot of listed companies, especially those companies who generates a lot of cash, they keep doing buyback, like so like TCS, Infosys, and all. The reason for that is that there was a tax advantage. Of course, the latest Finance Act has sort of changed that. But before that, if you are doing a dividend distribution, for example, it was taxable at a higher tax rate in the hands of the shareholder. Whereas if you do a buyback, it was taxable at a 20% plus surcharge and all this. So from that perspective, it had a very good advantage from a tax perspective. And that's why so a lot of cash generating companies used to go for a buyback. And capital reduction. Capital reduction is a situation wherein, say, the company would like to distribute cash to its shareholders. Now, in case of buyback, there are restrictions from a Companies Act perspective in terms of how much buyback you can do. There is a threshold of 25% and all. Whereas in case of capital reduction, there is no such, there is no such threshold. However, from a capital reduction perspective, you'll have to approach the NCLT. It's a court-driven process. It takes about 9 months to 12 months to. But in terms of distributing the cash of whatever is excess in the company, that you can do it. This slide summarizes some of the key drivers in terms of the consolidation in terms of M&A. The first one is the consolidation of business or unlocking value. So this I touched upon the previous slide that so consolidation happens in case of a large companies, for example, wherein you have multiple legal entities and you want to create synergy by consolidating all of them. Then unlocking value, Bajaj case, which we have discussed, and there are so many other upcoming so thought process from some of the large companies also, like Reliance, Vedanta, wherein they want to sort of unlock the company's value by creating multiple companies by way of the demerger process. Streamlining the operation and savings of cost. So this is an added advantage in terms of if you are going to go for a merger or a demerger, especially in case of mergers, there are situations wherein the company can streamline their operation. So that could be a situation where if you have multiple companies, each companies will have multiple employees with the same operation, be it admin, finance, and all. Now, by consolidating all of them together, you can streamline the operation and get some synergies out of it. Next is the explore any fiscal benefit. Now, in terms of one key benefit for a merger is also that you can get some so synergy in terms of fiscal benefits. Like if there is a loss-making entity merging with a profit-making entity, you can so create some tax set off over there. Another situation is where you want to set up a so plant in an SEZ area. Now, if you have to set it up, it will have a longer gestation period. Instead of that, you acquire a company which is already operating over there. So even the fiscal benefit could also be a driver in case of M&A. The next one is inorganic growth and enhancing the footprint. So typically from an M&A perspective, when a company wants to grow inorganically, not restricting itself for only the organic growth, a similar company can be bought by those companies. So these days we see a lot of such so deals happening in the pharma sector, in the chemical space, as well as in the FMCG space, wherein companies go on to acquire other companies for enlarging their footprints. So these are some of the illustrative drivers as such. There could be many other drivers depending on the facts of each case, the companies, etc. For example, so in one of the case which we were working, in that case, it was a startup which was started by three founders. Okay, so they had a so direct holding in the company. They also for some commercial reason they have their holding also structured through a partnership firm. Later on, some of the investor had come. Now, the company had grown to a sizable position. Now, the new investors have started asking why you are having such a structure wherein, some of your shareholding is directly held in the company, whereas, so few portion is held through the partnership firm. Now, as such, the founders, when they started that point in time, it was not thought through entirely. And, so they have set it up. Now, they have to deal with these kind of questions. So now the question is, can we do away with this partnership firm? So in case if you have to do away with this partnership, partnership firm, there are tax consequences. Because, when they have started the company, they have invested in this company at rupees say 10, the face value, say rupees 10 per share. Whereas, now the book value itself has grown multifold. So if you are going to transfer the shares or dissolve the firm, all the tax consequences will have to be followed through, and then you have to structure it in a better way. So that's another example of a key driver. Rather than there is no merger acquisition over there, but due to certain commercial aspects wherein the promoters had to sort of deal with the situation of their holding structure, wherein they have to do away with the partnership. Similar is another example is a hospital. So they are claiming 35 AD currently. They have a set operation already. So that's running for about 5 years now. But they have grown beyond their capacity in the current location. Now they would like to move to a larger location. Now, of course, they can move to the larger location, but 35 AD comes with certain lock-in periods. Okay, so and then obviously if you are moving to the larger location, you will shift some of the facilities from the infrastructure, etc., from the current location. So would that constitute a reconstruction for the new operation? Now these are some of the aspects which will have to be dealt with in terms of the M&A perspective. But the driver here is for the business to grow rather than any tax consideration, etc. Now, so this slide I have summarized a few consideration, which are the key considerations, so to say. So as you would see, tax I have not placed at the top of the bullet points. The reason is that so tax is one of the element of a M&A. It's not the only element. The major driver, as I said, so commercial. It could be a synergy, it could be an expansion, it could be on account of a divestment or a desired shareholding structure. So the desired shareholding structure, we have dealt with one example earlier on the partnership firm. There is one more case which I've dealt earlier, wherein it was a large group. The group had a thought process of acquiring smaller startups, say about 100 CR, which has achieved 100 CR turnover, etc. And then, so they will acquire 50% of it, rest of the 50% will remain with the founders. Over the period, they have acquired multiple such startups. So now they have grown, like, they have a holding company or multiple holding companies which holds various startup companies. Now they have a target that, each of these 100 crore company will become, say, 1,000 crore company. So they want to consolidate all these companies together with a holding company, and then below that, all the operating companies. Now this is a the key consideration here is not only the tax aspect and of course the other regulatory aspects. The other aspects that one will have to deal with are, for example, since you have multiple companies, each companies come up with their own set of challenges. There are different stakeholders because company A, for example, is founded by two persons, whereas so another startup which has been founded by another 3-4 guys. Now all these people will have different set of thought process to where they want to move in terms of taking their companies. Now, if you are consolidating everything, they will come up at the holding company level. Their shareholding will come at the holding company level. Whether they'll be okay with it, there'll be few who may not be interested in doing so. There may be few who would like to sort of exit from the company. Now, these are some of the factors that will have to be considered while doing this. So in that case, for example, the major thing which we were working, there were quite a few iteration around it was on the cap table, because you have at the holding company level the large shareholders who is creating this entire platform, whereas at the operating company level you have founders, as well as in some of the companies you have investors who have invested. Now, to align the interest of all these stakeholders and get the desired cap table, because so when you are doing a sort of say a merger, then so you will have to take care of the valuation, so that the original promoters as well as the founders and the other stakeholders, they are not anywhere detrimental in terms of getting their right legal so ownership in the company. Another example that comes to my mind is subsidiarization. For example, a large company that has multiple businesses. Now, a PE investor comes and says that, okay, I'm interested in one particular business and not in all the businesses. So as such, the PE investor will not be able to invest in the main company itself, because there are other multiple businesses also. So one way is to sort of carve out the business from the main business, put it in a subsidiary, and then bring the investor. We have a case study on this. We will cover that up. But again, so this is more of a so consideration driven from a commercial aspect, that there is an investor who would like to come in and invest in a particular business rather than on all the businesses in the company. Another case of so commercial consideration is a situation wherein the company had, say, 10 years back, had invested in a research heavy business overseas. That's a business which is situated in the Europe. And so over the period they have pumped in a lot of money to do the research, etc. But the desired objective or the goal was not achieved. So it has started incurring losses, and the benefit from that investment had not come through. Now, so they had a situation wherein they wanted to stop the further funding, and also see that how they can sort of sell it even at a loss. They would like to sell it. Now, this is a commercial consideration basis which so things have started, but there are tax consideration also here, because if it was a listed entity which has sort of invested in the European company through a intermediary holding company in Mauritius, for example. Now the question is, so how they would be able to get the losses at the India level, because they have invested. So interestingly, it was invested through funding, debt funding. So in a situation wherein if it is invested through a equity investment, then doing a write-off and claiming a business loss could be a challenge. Whereas in a situation wherein if you have invested in the form of fund in the loan fund, then there are positions which you can take wherein you can claim the losses as a business loss. Now, how this would be done in terms of from a legal regulatory aspect as well as from a tax compliant manner were the question of analysis there. There we had a discussion with the councils, etc., both from FEMA angle as well as from a tax angle, wherein we got a view that as such, so since this is a listed entity, if they have given the loan and if they are going to take a write-off, because so they were also selling the underlying investment. So when they sell the underlying investment, the loan repayment is not going to come back. So from that perspective, it was possible to take a position that this loan write-off is a claimable expenditure, and also it is allowable from a FEMA perspective, because it was a listed entity. Whereas if it was an unlisted entity, then probably you have to go and take RBI's approval for that. In terms of Companies Act, so again, from a Companies Act, there are valuation requirement. Now there is a registered value requirement for any issue of shares, for buyback of shares and all. And then if it is a merger situation, you will have to get the approval of the shareholders. You will have to get the approval of the creditors. There is a way in which you can dispense with the creditor shareholder meeting through the court process. If you get, say, for example, 90% of the shareholders and creditors, no objection, then you can dispense with the meeting. Otherwise, in the court convened meeting, the shareholder and the creditors will have to approve the scheme with majority in numbers, that is more than 50%, and with 3/4 of the value in terms of value. So these are some of the considerations which we'll have to take care from a Companies Act. From a SEBI regulation perspective, a lot of IPOs coming up these days. But when it comes to IPO, so you will have to first meet all the requirements of the SEBI regulations. And also there are situations where before the IPO, you have to do certain restructuring to the IPO. Like the company would like, so the company is, for example, in an auto space. Auto ancillary space, for example. Now they have entity, the main entity, and then below that there are multiple entities, or the promoters are holding so few other entities also, which are also in the same business. Now they want to sort of consolidate all these things, or there is a business within the legal entity which is not in the same space, so they want to carve out. There is an immovable property which they don't want to share it with the public when they come on listing, because it is not directly related to the business. Now these are the factors on which you'll have to take a deeper look into the company structure and see whether there is any restructuring required. And of course, so this will have to fall with the necessary regulations from a SEBI perspective, because if you are doing any kind of restructuring immediately before the IPO, it should pass the test of smell test, basically, because so if there is a aggressive any kind of so structuring which you have done, and if it is detrimental to the it could be perceived as a detrimental to the shareholders, public shareholder, then the IPO may not get the desired result that it is required. FEMA regulations. So FEMA regulations is another aspect which is a key consideration in a deal. For example, so we were working on a company wherein it was a payment solution provider. Now they have they wanted to acquire a company outside of India. Okay, so as such, they were loss making, being a startup, and of course they are running for about 10 years, but still they are making losses. So if you have to invest in a foreign company, you have to have this track record of profitability, etc. So the question came up as to how we can sort of acquire this foreign entity. There, one way was one structure which was envisaged, that they acquire a smaller company which had that track record of profitability. Now the smaller company will sort of acquire the foreign entity. Now there again, so they have envisaged a situation wherein they wanted to do a share swap. That is, the Indian entity will buy the foreign entity, and against which the Indian entity will issue its own shares. Now, so very recently the RBI had sort of so changed ODI regulations on this aspect. Earlier there was no clarity on whether the so the swap was possible or not, while under the FDI it was possible. So now with the revised regulation, they were able to do this transaction. Tax consideration. So in terms of tax consideration, so there was one example wherein the company it had a huge operation in the healthcare segment in the US. Now this company was held through a Netherlands entity. They want to divest this entity. That is, so the Netherlands entity would sell the US co to a third party. all said and done, so it's a clean deal as such. There is no problem. But Netherlands entity was a holding company only. So there is this question of place of effective management poem. So in case if the place of effective management of the holding company, that is in Netherlands, is in India, for example, then this sale potentially could be taxable in India. Otherwise, so since the Netherlands entity is selling the shares, it should be taxable only in Netherlands or in the US, wherein the US companies, so wherein the companies are operating. But if there is an allegation from the tax authorities that the Netherlands entity has its place of effective management from India, then possibly there could be allegation that so this gain should also be taxable in India. Now there we have sort of dig deeper. Of course, so we were helping on the from a sell side perspective, but so we had to address this poem issue, wherein we have what we have done. We have dig deeper into their operation, their board resolution, etc. Interestingly, the person who was the CEO, he was sitting from the US. He was operating from the US. He was a board member in that US company. He was also a board member in the Netherlands entity. And from that perspective, we could have a very good, fact pattern wherein, so the entire operations were driven by that person. He was also negotiating the deal, the deal which was supposed to happen. So all those decisions were, taken from outside of India. So from that perspective, we could conclude that, so there is a good case to argue that the poem of this company, the Netherlands entity, should not be in India. And hence, that the any gain arising on that sale should not be taxable in India. So this is a classical case wherein, so a tax consideration plays a vital role. While it was a straightforward deal wherein, so if you are selling it from a foreign company outside of India, ideally the gain should not come to India. I mean, it should not be taxable in India. But this is because of the poem regulation, etc. We had to sort of go further and understand these aspects and sort of come up with it, the outcome. Stamp duty. The stamp duty is another aspect which will have to be considered in terms of deal. For example, a merger, typically, as we understand, it's a tax neutral transaction as such. When there is a merger, as such, so if it is court convened and if you are meeting the conditions under section 21B, 47, etc., then such case will not be so taxable from an income tax law perspective. However, since you have there is a clear legal ruling on this aspect that so a merger scheme approved by the NCLT is a convenience, and from that perspective, stamp duty shall be applicable. Now, the moment the stamp duty applies, the question comes up situations wherein, for example, if you have operations in multi-states, a Bombay registered company, it has operations in Gujarat, it has operations in Dehradun, etc. It has plants over there. Now, whether so stamp duty will be applicable in all the places. Whether stamp duty will have to be paid, say for example, they have a plant, they have a land and plant over there. Now, whether the stamp duty should be restricted to the extent of the value of the land over there, or on the entire merger consideration. Now, this is a very peculiar case, and so it comes very often in a deal situation. And then another thing is that so since you are registered with both the state, let's assume there is no immovable property. So you have a company registered in Gujarat. It has operations in so it has the other company. So there are two companies. One company is in Gujarat, the other company is in Maharashtra. Now both the companies are merging together. Now, as such, this will trigger a stamp duty in both the states, because so you have to register the conveyance, and then so if there are properties, etc., you will have to register with the stamp duty authorities and accordingly get the approval. So this will trigger a situation wherein you have to pay stamp duty in both the state. There is a recent Supreme Court ruling in the case of Reliance, wherein as such, their plea was, since it is for the same scheme, I should be given a credit if I pay in one state, in the other state. but it was rejected by the SE, and as such, so the rule is that you'll have to pay taxes in all the state. Now to overcome this, so we have situations wherein, so we have done in many cases before the merger, we sort of, so shift the registered office of, say in this case, the Gujarat entity to Maharashtra. So in which case, so before the merger even starts, you first shift the registered office of Gujarat entity to Maharashtra. Then you file for the NCLT scheme and get the scheme approved. In that case, the stamp duty will be restricted only in Maharashtra and not in Gujarat. Yeah. See, registered office, so it's a matter of 2 to 3 months. It's an ROC driven process, which can be. Yes, yes. There is no challenge.
You have to get labor permission also, no? Labor.
So, sir, if you have operations, etc., so as such, so those operations will continue over there. So let's assume, so labor laws, you are saying, so. We have not at least, so come across such situation because, so we have done it even for manufacturing companies wherein, the registered office was moved, and as such, from the ROC perspective, it was approved.
What is stamp duty adjudication?
See, stamp duty adjudication is a situation, it's basically a consequence. So first you complete the merger process, which is driven through the NCLT process. Post which, as I said, the scheme approved by the NCLT is a conveyance. So like, for example, if you are entering into a sale deed for your property, that conveyance has to be registered with the stamp duty authorities in order to get the property ownership transferred from, say, from the seller to the buyer. Similarly, in this case, if there is a merger, post the merger order, you file this order with the stamp duty authorities and have your conveyance adjudicated. So that process is called stamp duty adjudication. With the stamp duty authorities.
Thank you.
Again, one more aspect on the stamp duty is in terms of the stamp duty rate itself. So in Delhi, for example, a merger attracts a stamp duty rate of 3%. Whereas, so in Mumbai, it is in Maharashtra, it is 0.7%. Of course, there is a set formula, but effectively, it will be 0.7%. In Gujarat, it is 1%. Again, there are interpretations to say that 1% will be on the face value and not on the market value. Whereas in other state, it is on the market value of the instrument issue. Now, so again, this also, comes up with a lot of planning wherein, so if you have the state, the companies registered in Delhi, rather than implementing the scheme over there, you transfer the registered office to a state which has a lower stamp duty. So that is also been done. Yep. So you have Maharashtra, which is 0.7%, Gujarat 1%. You have Tamil Nadu, for example, 0.6%. In Chandigarh, there are interpretation that no stamp duty should be applicable. Yeah. So yes, good point, sir. So see, the formula, the way it has been worded, it is in Maharashtra, for example, it's the higher of 5% of the immovable property or 0.7% of the market value of the shares issued. So you'll have to pay the higher of these two, subject to the 50 CR limit. Yeah, it has to be on the stamp duty value. Yeah, ready reckoner value.
So what about leasehold property?
So leasehold property, as such, sir, so it is again, so subject to certain interpretation. It depends on the leasing period. So if the lease period is, beyond certain period, there are, states which says that stamp duty has to be paid. And there are situations wherein, the state have accepted that, on lease, it should not be applicable. Now, similar situation also comes under the income tax law from a 56(2)(10) perspective, for example, wherein if you have a leasehold property and a freehold property, definitely you have to apply the reference rate.
So there is premium to be paid the state government. Yes.
Yes, on the transfer you are saying, right? Yes. So in that case, it would be applicable. Yes. So I was on. Yeah.
In the case of merger, stamp duty is applicable. Demerger?
Demerger also stamp duty is applicable. So it goes in the same way, wherein, so you have
The merger is done. The company which had a division, which is a property, remain in the company and carve out the division which don't have property. Then
So again, so in that case also, so you have a situation wherein, and so very, very interesting question. So you have a company which has, so immovable property, and you have a business operation. Let's assume it's a service business, which has no, so large properties, etc. Now, if you are carving out the service business per se, and you are putting it in another entity, and that entity will sort of issue shares to the shareholders of the demerged company, right? Now, on this value of the shares, stamp duty will be
that point,
0.7%. Because in that case, 5% of the immovable property is nil, and you apply 0.7% on the value of the shares, market value of the shares.
Sir, transfer of legal right is subject to GST also.
That's true. Yeah.
Income is also to pay, stamp duty also to pay, and again GST also.
Yes, yes.
What will the advantage in doing any merger or demerger?
So there are situations wherein, sir, it's a valid question. You have to also see the other aspects of a merger. Like, so as I said, it's not driven by, so tax and then stamp duty, etc. You have other, so consideration commercially. So synergy, etc.
Input, GST input rates will be under.
GST input credit is applicable.
No.
Highly debatable issue.
Taking commercial considerations, make it
18% the big
cash flows and all this.
Yes. So in fact, GST, we have, so very interesting things, which is a burning issue these days in M&A. Wherein typically when a promoter sells the business, be it in terms of share deal or a business deal, there is a clause in the share purchase agreement or on the business transfer agreement on the non-compete. Okay. Now these days, the GST authorities have raised a question that whether on the non-compete GST should be applicable. Their allegation is that GST should apply. But the question is, so as such, the core of the transaction is sale of the business or the shares. As such, so we are not getting into a simpliciter non-compete kind of situation. It is a consequence. Non-competition is a consequence of the share sale. So if you have left out the agreement with the whole number, say 100 CR is a value of the business. The allegation from the tax authority is that on the entire 100 CR, GST should be applicable. Now, this is a very, very typical situation. Now, how do we deal with this? So we say that, for example, you allocate some portion of your consideration to the non-competition, say 5%, 10%. And then on the other hand, so for the balance, you say for the shares. Now, again, here, the question is, commercial angle. When it comes, if you have specifically allocated, say, only 5% of the deal size, deal value for the non-competition, if there is a dispute tomorrow, your ability to get back anything would be limited to this 5%. So as a buyer, you might not be comfortable with this kind of so specific amount to be put in the agreement for this. But you have this conundrum wherein from a tax GST angle, you have a tax implication, whereas so from a commercial angle, you don't want to do that.
Non-competent in the hands of the director. Separately.
No, not necessary, sir. So non-competition, so as I said, it could be in both the business transfer agreement as well as in the hands of the shareholder if they are selling the shares. So it will be in the hands of the shareholder. You're right. So in case of a share purchase agreement, but the way so tax authorities are alleging that so by entering into this kind of so agreement, you are depriving from acting on a certain way. So hence that becomes a service, and from that perspective, stamp duty shall be applicable. Of course, it would be in the hands of the seller, but the question is, so from a transaction perspective, you will have to pay the taxes. So how would you do that? Is the question. Yeah.
Since we are talking about fees, from an income tax perspective, what is your view whether the HDFs are allowable as a reduction? If yes, then should it be capitalized? And pay for depreciation or direct reduction of expenses?
It's a, so no, he is asking from a buyer's perspective, right? From a buyer's perspective, see, as such, if you're not, putting a specific number to the non-competition, as such, there is no question of claiming it separately. The question comes up when you are putting a specific number to that.
What are the allocation?
Yeah, you're right. So in the purchase price allocation also, so you have situation wherein, so in few deals we have seen that, we don't ascribe a number to that, or we deal it with a very small number. But in case if you're putting a number to that, the question is, whether it is a claimable expenditure also. See, my view is that it's my view as such, so it is not a claimable expenditure. And so from a depreciation perspective, it has to be evaluated whether it will fall under the intangible definition. The next point is on the stakeholder comfort or the approval. Now, this we have dealt in that other situation wherein the company had a large platform for acquisition of FMCG, etc. Now, in that case, whenever you are doing any M&A activity over there, be it a merger, be it a consolidation, or so acquisition, etc., you have to take care of the other shareholders' comfort also, whether they'll be approving the scheme or approving the transaction per se before you get into that. Because as I said, so the key lookout for the shareholder in those cases would be whether they are getting the rightful stake in the holding company level. If their value of the company in the operating company say 500 CR, ideally they should also get the same value at the holding company level. And it is not restricted now post they get the shareholding at the holding company level. The value of that share will not be restricted only basis the operation or the performance of their own company. It will also be driven by the other companies, wherein they don't have any influence or control. So there's a classical example wherein you would have a situation wherein you'll have to, before doing these kind of transaction, you will have to also take care of the comfort of the other stakeholders. Entry and exit strategy. Now, see, entry and exit strategy. This comes up often in a PE investment situation, because so most of the PE investors, if you see, they come up with a time horizon of say 3 to 4 years or 5 years. So before even they enter, their question would be, okay, how would you give me an exit? Now we have seen a few situations wherein if they have come up as an investor in an unlisted entity, there will be a structured wherein we can sort of so take that company to a listed as a listed entity, wherein the PE investor could get an exit. There are situations wherein I dealt with one case wherein a US person wanted to invest in India in a real estate company. Okay, his ask was so he's investing say about 500 CR. The project would be constructed. So there is an identified land on which project will be developed. So the investment is to be made in a company. It's a developer with so experience and track record. So that developer has developed many such projects. But the investor was investing only in one of the projects. Now the question was, so whether he should invest in that specific project in a specific SPV. Should he invest in a company of his own and then that company will invest? Should he invest in the form of equity, whether it has to be in the form of debt? There was a condition from the investor that, so in 4 years, he should be getting 2x of the amount invested. So if he is investing 500 CR, the IRR should be 100% over the 4 to 5 years period of the project. So see, these are some of the consideration when we structure the entire deal. So that, so he will get this 1,000 CR at the end of the project. Of course, having regard to the cost, etc. So it could be, dealt in the form of say a CCD, could be in the form of equity, depending on the tax cost. You'll have to structure the deal. these are some of the frameworks on the tax regulatory aspects. Basically, we have touched upon many of these aspects in the previous slide. Stamp duty we spoke, CCI. So Competition Commission of so India. So that's another angle to many deals, especially in the large deals. Like so recently Tata Air India and so the other company they wanted to merge, so they have obtained approval from the CCI. We have the case of PVR and Inox merging. So they got the approval. So in fact, that was a case wherein by merging them together, you are creating creating a monopolistic kind of situation because 80% of the multiplexes will be owned by the combined entity in India. So that was a situation wherein the question was whether you will get the CCI approval or not. But so they have filed the scheme in a period where there was a slump in terms of their valuation and the profitability, etc. And from that perspective, they got the approval. Companies Act. So under the Companies Act, so any scheme of arrangement, you will have to meet the conditions and the various regulations from the Companies Act, which is covered under section 230, 234 of the Act. There, so either you can do a regular merger process, merger demerger process, which would be so through the NCLT process. Or there is a fast track merger also, wherein if you have a holding company, subsidiary company, wholly owned subsidiary company, then in that case you can do a fast track merger also. Again, so there are pros and cons to both of them, because in case of court approved process, you have a proper court process wherein the influence is lower. Whereas in case of a fast track merger, the only approving authority is the RD. So you have the entire case dependent on the RD. So you'll have to so see both the pros and cons. But in terms of timeline, you can achieve a fast track merger in case of an RD process. Accounting implications is an important aspect. So post the merger or post the demerger, how the balance sheet of the resultant entity will look like. Whether because of the various accounting treatment, whether it will have a positive impact on the balance sheet or it will have a negative impact on the balance sheet. Because in few of the listed cases, the so the analysts track the company basis certain criteria like return on capital employed, what is the profit margin, etc. So if you have a situation wherein two companies are merging together, so that's why so in most of the merger cases that when there is an analyst call, the question would be whether it is margin accretive or not. The reason for that question is, say if the acquirer is already making a 20% margin on its business, and if there is a new business coming in post the acquisition, and so if it is less than 20%, then the overall margin will be hit negatively. Whereas if you have a higher margin of the target entity, then you could have a positive impact. Securities law, SEBI regulations approval. So this we spoke. In terms of tax implications, we have covered most of them. In terms of so we'll have to see in the hands of the shareholder, in the hands of the company, which is so doing the. So sir, GAR implication is very specific to situations. So it depends on the facts of the case. So as I said, if the merger transaction or the transaction is driven on account of the commercial aspect, the other synergies, etc., then you have a very much a defendable case. Like for example, in the case of I spoke about this PVR Inox case. Now that's a case wherein it was driven by commercial aspects. So we have dealt with another situation wherein so there was a merger of a loss-making entity with a profit-making entity. Now at the outset, one would say that okay, see the main reason is for taking tax advantage. But on the other hand, the loss were incurred by the loss-making entity because of its the place of operation, the management, and all those aspects. So now they wanted to combine these two entities so that they can streamline the operation, they can get the synergy in the combined entity and turn around the loss-making entity into a profitable entity. Now, this entirely depends on the facts of the case. For example, so we have one case study which we will cover, wherein it's a publicly available case in the case of Aditya Birla, wherein they have sort of demerged their investment undertaking. Now the question was, so whether this investment undertaking divestment through a demerger process, which whether it will qualify for the demerger or not, as a that whether it will qualify as a tax neutral demerger from a tax law perspective. Now, as such, the department has not argued on the GAR aspect, but they can also go beyond that, and then they could also pick the case from a GAR perspective. But the argument from the taxpayers perspective was more on the commercial rationale for doing so, because they had that financial service business, which was done by them in multiple entities, and they want to sort of bring it in under one entity. We'll cover that case in detail. So to address your question, GAR is a very specific case, and you will have to evaluate the facts of the case to understand whether it will be applicable. If you have a proper commercial reasons to do the transaction, then it should pass the smell test. In deal situation, one of the important aspect is on the withholding taxes, especially if say for example, if a company in India, it is buying another company, say from a shareholder outside of India, from a non-resident shareholder basically. Now let's assume this non-resident is coming from is holding the Indian entity through a intermediate holding company either in Singapore or in Mauritius. Now the question comes out that so whether while there is a treaty protection, because let's assume the investments were made before 1st April 2017, then you have a treaty protection under the Mauritius and Singapore treaty. Now the question is whether this intermediate holding company, it has its own substance, whether so it is a operational entity, and so all the decisions are being taken from Singapore or Mauritius. Depending on that, the treaty protection will come. Otherwise, so if there are many cases these days, Tiger Global and other cases, wherein so the treaty protection itself was denied by the tax authorities, alleging that the Mauritius entity in that case was not having any substance, and all the decisions were driven from the outside of Mauritius, and from that perspective, the India-Mauritius treaties protection should not be available. Now, so from a buyer standpoint, why this is important? The reason is that from a buyer standpoint, if I so I conclude that as such for the seller, the tax treaty protection should be available, then I will not withhold the taxes. Whereas in a situation wherein if the conclusion is otherwise, then I'll have to withhold the taxes. Obviously, from a seller perspective, he will not agree for the withholding of the taxes. So then how do we protect, and when it comes to negotiation, these points will be discussed. There are situations wherein, we get deeper into the company, understand its operation, board meetings, etc., and then finally conclude as to whether that should be available or not. And secondly, this can be also protected. Let's assume, so we take a position that as such withholding shall not apply, but so we sort of cover that up with an indemnity or an insurance. So these are manner in which the tax challenges could be sort of mitigated. There is this no objection certificate, indemnities, warranties. Indemnities, warranties we have covered sort of. No objection certificate is from a tax law perspective under section 281. So section 281 provides a right in the hands of the tax authorities if they see that the seller has not discharged his liability properly. If there is a dispute that comes up at later point, then in that case they can so consider the transfer as a voidable transaction. So from a buyer standpoint, this plays an important role, whether the seller has discharged all his liabilities, or if at all it comes in future, whether he has the ability to sort of discharge it. So So for this to either you go and get a 281 no objection certificate from the tax authorities, or you have a certificate from a chartered accountant wherein, so you get the comfort that there is no major liability that can come up. Now, this is very important from a deal timeline perspective. If you go for a no objection certificate with the tax authorities, there is a possibility that tax authorities might not give you in the desired timeline, in which case the deal could be so delayed. So practically speaking, in most of the cases we seek a 281 from the from a chartered accountant repute, so that we are able to run the deal in a desired timeline. Sorry, FDI ODI, I think no, so FDI ODI, I've given you one example, so the acquisition. Cross-border merger, so these days, cross-border merger has been a talk of the town. The reason is, so the reverse flip. So wherein a foreign company, so all these startups, for example, Flipkart, etc., when they have started initially, they were seeing that a lot of tax and other regulatory issues from India standpoint. This was 10 years back. And so they have set up their holding company at, say, Singapore or any other country, which is so quite favorable from a tax regulatory angle. And then so they have owned those shares from that holding company. Now, so off late, if you see with the India economy growing, with the market providing a high multiples for these startups when they come up for IPO, etc., there is a very conducive environment in the Indian market, and hence they would like to sort of bring back the holding company structure to India. So that's why so you see a lot of so you have this case of Pine Lab, you have the case of the other PhonePe, etc. In which case they have moved their holding company from other states, other countries to India. Now, this is typically done either through a share swap. In case of PhonePe, for example, they have done it through a share swap, which is obviously it will be a taxable event because so the foreign companies held by the individual shareholders or the investor, they are going to do away with that shares and get the shares of the Indian entity. So there is a transfer of the foreign entity's shares, and hence so that will be taxable in India, subject to this indirect transfer regulations and all this stuff. And also, so you'll have to see the taxation in the respective foreign country also. In few cases, they have this holding company at the US. Now, the moment, in the US, the laws are, very clear that if there is a transfer or if there is an exit from there, you will have to pay taxes. So this comes up with a lot of regulatory aspects and the tax implications. Pine Lab is a very classical case wherein instead of doing a swap, now they are implementing it through a merger, cross-border merger process, wherein the Singapore entity is being merged with the Indian entity. So from an Indian income tax law perspective, the inbound merger are typically will be tax neutral because the condition is the amalgamated company should be a Indian company, so which will be met in this case. So, but so earlier Singapore was not allowing cross-border merger. That is, any outbound mergers were not allowed in Singapore. Now, so Pine Lab was a very, so interesting case wherein they have went on and convinced the Singapore authorities and the court thereon, wherein they got this. Moving on, so these are some of the. So we'll touch upon some of the basic concepts of merger. So amalgamation, as you would know, it's a case wherein so two or more than two entities come together, and it is merged through a court-approved process. Now, in order to get the income tax tax neutrality from a tax law perspective, you will have to ensure that all the properties and liabilities of the amalgamating company are transferred. 3/4 of the shares in value, the shareholders holding 3/4 in value, they should get the shares in the amalgamated entity. If these two conditions are met, then so you will get the tax neutrality. And from a 47 perspective, which we'll cover in the later slide, you will have to ensure that the Indian company the amalgamated entity is an Indian company, in which case you will get the tax neutrality for the company which is the amalgamating company, because that is transferring all its assets liabilities, will get a tax exemption, and also for the shareholder of the amalgamating company, because they are parting away with the shares of the company, amalgamating company, and getting shares in the amalgamated company. And so you will get the tax exemption, provided so two or three conditions are met, you meet the conditions of 47 as well. Now, question may arise if you are doing a merger of your boss with the holding company. In that case, as such, the shares will not be issued. So whether you will get the exemption tax neutrality? Yes, the answer is yes, because so there is a specific exemption provided in the law itself. It says that so if the amalgamated entity is already owning the shares, then that should still qualify for the tax exemption. These are some of the illustrations, basic illustration wherein how the amalgamation is carried out. So it could be a situation wherein you have two different set of shareholders owning company A and B. Both of them come together. The combined entity, all these shareholders, that is shareholders of company A and B, will be shareholders in the combined entity. So these are cases like Vodafone Idea, wherein it was a two set of companies altogether, they came together. Then you have the case of subsidiary company merging with the holding company, and the reverse merger, which is holding company merging into subsidiary. This one we generally see. So we spoke about reverse flip, wherein so the Singapore holding company got merged with the Indian entity, or so it could be with any other country also. And then there are so in the listed space you would see that a lot of companies, listed companies, are held by the promoters through a holding company. Now, in order to get direct access to the shareholding in the operating company, so there is a situation wherein they have merged the holding company with the operating listed entity. So this point we covered in the hands of the taxation in the hands of the amalgamating company and the hands of the shareholders of the amalgamating company. The condition is that you'll have to meet the condition of 2(1)(b), of course. And in addition to that, the amalgamated entity should be an Indian entity. And for the shareholder, the consideration should be in the form of equity shares. So if you are issuing, so the consideration is disposed otherwise than by issue of shares, then you will have a problem. Now, so the question may arise whether it will have to be only equity shares, or if you are issuing preference shares, would that also qualify? So in case of merger, instead of issuing equity shares, if preference shares are issued by the amalgamated entity, would it qualify? It should, as such, because the wording used in the act is, shares. They have not mentioned specifically equity or, pref share, etc. So even preference share also should qualify. In terms of cost of acquisition of shares received on amalgamation by the shareholder, so the cost should be available in the hands of the so both in the hands of the shareholder as well as in the hands of the company which is transferring the shares. The period of holding will be the period of holding, including the period of holding of the amalgamating company. For if it is stock, capital assets, etc., the cost of acquisition will be as it was held by the amalgamating company. For depreciable asset, it will be the WDV. Period of holding we have covered. This expense in relation to amalgamation will also be available. You can claim it 1/5 basis. Now, demerger, some of the basic concepts are, so from a demerger perspective. So, okay, before getting into the taxability, demerger is a situation wherein a legal entity is sort of, owning shares, it has multiple businesses, and it would like to demerge its businesses into separate legal entities. So we have seen this in case of, say, for example, in Jubilant Pharma. And there are so Bajaj I quoted as an example, wherein the objective in that case was the company was having both the businesses, the auto and as well as the finance business. Now they wanted to unlock value, and hence they wanted to sort of so demerge these into two separate entities, wherein the management. So in that case, there were two sons, and they wanted to manage it separately. So it has enabled. So it was not only the value unlocking, but also from a family succession perspective, they have done it. So these are examples on demerger. In terms of tax neutrality, you have to identify all the assets and liabilities of the undertaking which is being demerged. It will have to move from one company, the demerged company, to the resultant company. That's condition 1. Condition 2 is the discharge of the consideration by the resulting company. It will have to be in the form of issue of shares, and it has to be issued to proportionately to all the shareholders of the demerged company. There is one more condition, which is at least 3/4 of the shareholders should also get they should get the shareholding. So the question may arise, so between this bullet point 2 and 3, which are clause 4 and 5 of section 219AA, whether this will overlap each other. In a situation wherein, for example, you are issuing shares to only 3/4 of the shareholders. So would you meet the condition in the second bullet? So the answer is, so as such, you'll have to read the law harmoniously, because so if you are saying that you have to issue shares to all the shareholders, then in that case the third bullet will become redundant. That is, so only by issuing the 3/4 of the shareholders, you will not get the qualification from a tax neutrality perspective. So you'll have to read it harmoniously, wherein if you are issuing shares to at least 3/4 of the shareholders in their respective proportion, then still you should qualify for the tax neutrality. Of course, the business has to be sold on a going concern basis. In terms of undertaking, we'll have to cover this undertaking aspect even for slum sale. There could be some questions which may arise if the undertaking is transferred. What if certain assets and liabilities are not transferred as part of this process, be it in the process of so demerger or in the case of slum sale, whether it will qualify as an undertaking. For example, so you have a manufacturing business. Okay. Now, out of the manufacturing business, say you are leaving the debtors of the business. When you are transferring, all the debtors as on the transfer date are left out, and that's not been transferred as part of this. So would that qualify as an undertaking? There is no straight answer to this. The reason is that so there are contrary rulings on this very topic. There are situations where, for example, as part of the transfer, the transferor did not transfer some of the liabilities. Say there is a bank loan. Okay, for whatever commercial reason, it was agreed between the parties that they don't want to transfer the liability. There are situations wherein a specific plant. So let's assume the undertaking comprises of, say, 3 plants, and one of the plant is not being sold out. At least that should qualify, because so the definition says either the undertaking or part of the undertaking. But we had come across a situation wherein it was a single plant in case of a pharma company which was sold out, but the seller intended that the manufacturing plant itself would be retained, whereas the entire the brand, it was a OTC product basically. So the brand will be sold out, underlying customer, underlying creditors, suppliers, and the employees, all those aspects will be transferred, whereas only the plant which was running to manufacture this pharma product would not. So the question came to us whether this should qualify for the purpose of undertaking or not. So based on our research, we sort of concluded that it should still qualify for the undertaking. Now this is quite debatable, but so we concluded that it should be possible, because when you're transferring the undertaking, the going concern test will be met here. Because even after taking over the business, because the brands are transferred, the customers, suppliers, the employees are transferred, the acquirer will be in a position to sort of run the business. He might get a, for example, so a contract manufacturer to manufacture the business. As such, the going concern test would be met.
Question.
Yeah.
Who will remain the owner of that undertaking which is not transferred?
So in case of demerger, the demerged company will be the owner. It will continue to be the owner. So this slide will answer your question. For example, so you have this case wherein there is shareholder, you have demerged company that has unit A and unit B. So that is, business A and B. Now you are demerging unit B to the resultant company. Okay, so basically the unit B moves to the resultant company, whereas unit A will continue to remain with the demerged. Does it answer? So this illustration talks about situation of, so non-mirror shareholding demerger vis-a-vis a mirror shareholding demerger. So in case of mirror shareholding demerger, what happens is the entity. So in this case, on the right hand side, you have shareholder, you have demerged company, which has this unit A and B. And B is demerged, and the resultant company will issue shares in the same proportion to all the shareholders of the demerged company. So which means post the structure is implemented, both demerged company and resultant company will have the same set of shareholders in the same proportion. So that becomes a mirror shareholding demerger. Whereas on the left side, already in the resultant company, there are other shareholders. So it might not, so result into a mirror image shareholding.
Just to understand, suppose in the mirror shareholding, 150 crore is the capital of the company. You are talking about the resulting company will get a 70 crore capital or how?
So that depends on the valuation.
Suppose valuation is 1 to 1.
Okay.
I told you 150 crore, okay?
Okay. 150 is at the value at the shareholder level.
Shareholder level.
Okay.
But today I assume the 15 crore share.
Okay.
Correct? Now the resulting company will get a 75 crore share.
So okay. So in your example, assuming so both unit A and B are so equally value.
Yeah.
So the value of the shares that will be issued by the resultant company will be 75 CR.
And 75 will remain in the old company.
Yeah. Now, sir, just to so refine your question, it depends on the cost. If your question is more on the cost of the shareholding.
Principal, how principal is it?
Yeah. So principally speaking, so see, when the shareholder is in your case itself, let's assume that the shareholders are invested in the demerged company. Initially, they had invested at say 10 CR.
Yeah.
Okay. Now that value has gone up to 150 CR.
Correct.
Okay. Now equally, unit A and B are equally valued. So the resultant company, when it is issuing the shares, the value of the shares will be 75 CR.
Correct.
Right? So there is a formula given under the Act wherein, so under section 49(2)(c), which gives the shareholder the ability to sort of split this cost. So the original cost was 10 CR. Let's assume as per the formula, the ratio works out to be 50-50%.
Yeah.
So the shareholder will have 5 crore worth of shares, of course, which is, so the market value is 75 CR in demerged company. And also he will have shareholding worth, so the cost is 5 CR for a 75 crore worth of shares of the resultant company.
There will be capital reduction in the original company.
No, there is no capital reduction in the original company.
That's only a fact.
The original company's cap table will remain as is. There is no change in that.
Shareholders can that transfer also in that company.
Are you
For
asking?
example, 110 crore shareholders. And out of 10 crore shares that I want to get total shares of that company.
No. So that option may not be available. Of course, so see, structurally you can do that, but the question would be on the tax neutrality. So if you are doing that, then whether you will meet the condition of 3/4 shareholding, etc., will have to be checked. If you don't meet, then so probably tax neutrality will not. In terms of tax neutrality, so tax neutrality is similar to, so what we discussed for merger. So in the case of demerger also, you will get the capital gain exemption in the hands of the, so in this case, you have, two parties involved. One is the demerged company, which is demerging its business to the resultant company. So whether, that will be taxable. The answer is, so there is a tax neutrality provided you meet the condition of 219AA. And also the resulting company should be an Indian company. So if you meet these conditions, then you will get the exemption for the demerged company. And also you will get the exemption for the shareholders of the demerged company. Now, as such, legally speaking, in the demerger case, there is no shares being transferred by the shareholder of the demerged company. Because what is happening is, the shareholders of the demerged company will continue to own the shares of the demerged company. Only that, they will get new shares in the resultant company. So as such, there is no question of, transfer here, but still the law is provided for the exemption.
The number of shares will increase overall.
Earlier you would be owning one share, now you'll be owning one share of each of these two companies. Cost you will get for the depreciable asset, capital asset, as we discussed for merger. Period of holding you will get both for the shareholder as well as for the company. Cost of acquisition of shares received on demerger. So this we discussed that, so from a 49(2)(c) perspective, there is a set formula. The formula is that, you'll have to, segregate the value of the cost of the shares in the ratio of book value of the asset transferred vis-a-vis the net worth of the combined entity. Now, there are, so few situations which could come up that what if the net worth is negative? What if the book value, the question, another question is that, when they say net book value, whether you'll have to consider only the book value of all the assets or assets minus liabilities. Now, depending on the facts of the cases, there could be situation wherein, so the formula works out to be that, you have negative either at the numerator or at the denominator level. So in those cases, you may not be able to, bifurcate the cost at all. So in few situations, we have taken in such kind of situation, we have taken a position that as such, the cost of the newly issued shares, that is for the resultant company, should be nil. Now again, it's quite debatable. There is no clear-cut answer to this. You will have to take a call based on the facts of the case.
If that quoted share, resultant company is without not listed. Can we get unlisted forever?
No. So just to so correct that, as such, if it is a listed company's demerger, so in the case of Bajaj itself, when they have demerged, all the companies, all the resultant company also got listed. Typically, from a SEBI regulation perspective, if there is a demerger of a listed company, the resultant company will also will be able to automatically get listed. So immediately after the merger order comes from the NCLT, you will have to file it with the stock exchange, and then so within 30 days or so you will get listed. Stamp duty implication we covered. Slump sale. So slump sale, as we discussed, so a situation wherein the business is being transferred as a going concern by one company to another company. Now, so from a tax perspective, whether slump sale will be taxable event. Of course, it will be taxable because so there is no exemption as such provided under the tax law, unlike in case of demerger. Because demerger is a code-driven process, whereas slump sale can be implemented through a normal agreement. In terms of the way capital gain will be computed will be your sale consideration less the cost of acquisition. So net worth is the cost of acquisition for the transferor company. So net worth, tax net worth, you will have to compute basically, it's asset minus liabilities. For the depreciable asset, you will have to replace with the WDV of those assets. Earlier, there was so this question of slump exchange. Say, for example, if you are transferring the shares, business, and against which you are getting consideration in the form of say shares or any other kind instead of cash consideration. So based on a specific court ruling, uh, positions were taken that as such that so if it is a slump exchange, it should not be taxable. But later on, the law was amended, and wherein it was provided that as such, even on slump exchange, it should be taxable. So now they have come up with a 11 UAE rule for Section 50B, wherein there is a specific valuation guideline. So it should be FMV 1 or 2, higher of these two. So which is you calculate the book value of the business similar to how you calculate for 11 UA, that is for shares, wherein you take the assets, liabilities. If there are immovable properties, you replace with the stamp duty value, etc. Once you compute that, that is FMV2. FMV1 is the FMV1 is the net adjusted so amount, and then FMV2 is the amount that you get as a consideration. Both monetary and non-monetary. Higher of these two will become your consideration. Stamp duty is one aspect which is of an interest in case of slump sale. As such, so in slump sale, from a Maharashtra Stamp Duty Act, you have a specific entry for merger demerger. Whereas for slump sale, as such, the conveyance will fall under the regular conveyance, and hence so a position would emerge that 3% stamp duty shall be applicable. But there are so position which can also be taken that as such it is only the assets are there is an obligation which is being created on the assets pursuant to the slump sale, and accordingly only 0.2% stamp duty should be applicable.
Sir, issue of shares by resultant company, stamp duty should be paid.
So that is, if you are asking from a demerger perspective, yes. So you will have to go by that formula, that is 5% of the. Yes. No. So, okay. So there are two aspects. One is the stamp duty on the conveyance of the demerger per se, wherein, so when you do the demerger, there could be immovable properties from the transferor to transferor entity, on which 0.7% or 5% of the immovable property, whichever is higher, you'll have to pay. The second aspect is when the shares are being issued. So on that, you have 0.005% taxes, which will have to be. That's a separate thing. So this point we covered in terms of what was the change in order to cover the slum exchange. So earlier the language in the act was undertaking as a result of the sale. So sale was considered as only for monetary consideration. Then so post amendment they have included any means. So it could be by way of monetary consideration, non-monetary consideration. ATIA benefit as such, so there is a possibility of taking a position that ATIA benefit should be available, because so ATIA subsection 12 talks about a non-continuation of the ATIA benefit in case of merger demerger, whereas that specific language is not provided for slum sale. So it is possible to take a position that it should be available. Accumulated losses and unobserved depreciation, whether it would be available as such, so when the business is moved, as such, the legal entity has the losses, so it would not move along with the business. Buyback of shares in the recent budget, there was a change on this. So earlier it was taxable as a buyback tax in the hands of the company which is doing the buyback. Now it has been made taxable in the hands of the shareholder directly. Hence the tax consequences has gone up.
Buyback of shares can be done from the trade balance of profit and loss account.
Credit balance of.
Profit and loss.
Yes.
Can be appropriate for the.
Yes. Possible.
Without any delay in the delay.
Yes. Moving on, capital reduction. So capital reduction is a situation wherein so basically you reduce the capital by way of a court process and distribute the value of the shares at a fair market value to the shareholders. So this is in a situation, as I discussed earlier, wherein buyback has a restriction from a 25%, etc. Then in that case, you sort of do it with a so capital reduction process wherein you can distribute over and above the 25% also. Now, the one aspect of capital reduction is not only restricted for the distribution alone. There could be other reasons also. Like, for example, a company wants to sort of clean up its balance sheet. So it has assets on the on the asset side, and on the liability side it has so losses, etc. So it wants to sort of clean up rather than so in capital reduction they can reduce the balance of the negative balance, etc. and by writing off the assets on the asset side. So those could be the other reason also for capital reduction. There is one more situation which we have come up for capital reduction are situations wherein some of the shareholders would like to get an exit rather than the all the shareholders. Let's assume you have founders, you have investor shareholder. Now investor shareholders would like to sort of get an exit. Now, as such, the shareholder, the founder, the promoters are saying, they don't have enough cash, but the company holds the cash. So in that case, so possibly, so we can consider a capital reduction wherein a selective basis capital reduction can be done and the consideration could be paid from the company itself. Now, this is as such, there are contrary ruling from an NCLT perspective on approval of such scheme. Because in few cases they have negated or they have not approved the scheme having selective capital reduction. In a recent ruling, they have sort of so approved that. So depending on the facts of the case and other aspects, this could sail through. Sorry, which was? Yes, yes. It was anyway approved by the court process. So.
Now, if you do buyback, there's no capital. Then one would be share of buyback.
Sorry.
One rupee share has become 1800.
Yeah. So that's so within the legal framework they have done. Of course, so basically, so they have done it as per the FEMA, the SEBI regulations and all, which was so acceptable, and there is no question from a regulatory standpoint on that.
Out of 2000 shares, we got 2 shares.
That's more from a commercial angle. But sir, you have to also appreciate that that was an IBC case where the Ruchi Soya entity itself was not were not able to meet their debt obligation, etc. That was revived by the acquirer. Yes, sir.
Now buyback become a tax unfriendly. Because they do capital reduction on a tax-free basis. Can do.
Yes, you can do.
And collectively allowed now.
Yes.
Sir, what about the merger of Lakshmi Vilas Bank and Human Housing? Because new value, why it has been merged?
Sir, all those things, so depends on, so really on a fact basis. So there could be a number of reasons as to know why they do merger, etc.
Sir, retail shareholders are only 11% of total shareholders. How they can protect the assets?
So those are commercial aspects, maybe, so we'll sort of, so let's focus on the tax regulatory aspects. So as I said, so merger, demerger are also derived from in few cases from a regulatory standpoint as well as from a commercial angle. So those cases, of course, you might question that. Sorry? Yes. So this is a basic example of capital reduction, maybe, so you can go through that. In terms of time, I'd like to cover some of the case studies. In transfer of shares, the key elements are, so one is section 79. The moment, you do a transfer and if it is more than 50%, then, the losses in the transfer in the target entity may lapse. And, so from that perspective, the losses may not be get continued. So that's one aspect which will have to be considered. So in a situation where, if there is a group reorganization, wherein, some of the group entities are moved from one entity to another entity, then, this question comes up very often, wherein, the question is whether the tax losses will continue or not. So this is an element which will have to be covered up. There are, exceptions provided in the section 79. Then other aspect is from a 56(2)(10). So in many deal situation as well as in a corporate restructuring situation, we come up with this question on 56(2)(10). The reason is that, from a tax law perspective, you have a minimum value which is prescribed, at which, you'll have to sort of, transfer the shares. That is, so net book value subject to adjustment of stamp duty value of the immovable property and 11 UA value of the shares, etc. Basis that, you arrive at the book value, the basically the 11 UA value, and that is the minimum price at which you'll have to transfer. So in my earlier example on the partnership, the founders owning the company with the partnership firm. Now, one straight answer could be that the partnership firm simply transfers the shares to the founders directly. But, so as such, you'll have to follow the rules prescribed under the Income Tax Act, which provides that you'll have to at least transfer at the 11 UA value, which was, far greater than the initial invested cost. From a flip side, for the transferor also 50 CA would apply, in which case from a 50 CA perspective, the transferor will have to transfer it at least at the 11 UA value. So there could be situation wherein, if you are not meeting the 11 UA value, you will have a situation wherein it would be taxable both for the transferor as well as for the transferee. Because, so 50 CA would trigger for transferor, and at the same time, as a recipient of the shares, 56(2)(10) will trigger for the transferee. So we have, few case studies with which, so we can wrap it up. So this this is a situation wherein, so this was a case I was talking about. So for getting the investors. So this company had auto ancillary and chemical business. They wanted to sort of, get funding for the chemical business. Okay. So from a PE investor. So how the way we have structured the transaction is that, okay, we said you do the subsidiarization of this chemical business, wherein basically the listed entity will form a new subsidiary, wholly owned subsidiary. They will transfer the business at say the 11 UA value to the subco, post which the investor will come in, they will invest at the subco. Now, this also had why demerger was not considered in this case. The reason was that, so they wanted to implement the structure at the earliest because, the investor was keen on investing at the minimal possible timeline. And also they had the intention to sort of, list the chemical business separately. Like, they wanted to unlock the value separately for the chemical business. So to achieve these all these objectives, the step one was to subsidiarize the chemical business. That is, from the listed company, the business will be transferred at book value. And then, so the investor will make the investment. Later on, after stabilization, they will sort of, demerge one of the plant. So the way the transaction was structured, that the chemical business had some 5-6 plants, and one of the smaller plant was left out at the listed company level. The intention is that, when at a later point a demerger will be implemented to demerge this plant, the smaller plant, into the subsidiary, thereby creating a listed entity of the subsidiary. So step one, you first move the entire chemical business except for plant X, get the investor. Later on, you demerge the plant X to the subsidiary company, and then get the listed, get the subsidiary company listed. The resultant structure will be, you will have promoter and public at company A level, which is a demerged company with the auto business, and in the company B, which was a erstwhile subco, it will have the chemical business listed. There you will have the investor as well as the original public and the promoter share. We have seen a cross-border, we discussed about a cross-border merger. So this was again for a listed entity which we have worked out. So in this case, the listed entity was owning operational entity in Europe through a wholly owned subsidiary in Netherlands. Okay, now they wanted to eliminate this wholly owned subsidiary in Netherlands, and they wanted to own the operating entities directly. There were, commercial aspect. They wanted to cut down on the admin cost at the Netherlands level. They were not having enough substance at the Netherlands entity level. So those were the some of the consideration in order to consider this point. So the way we have implemented this one was that so as such there is, as I say, there is a possibility of a cross-border merger from an Indian regulation perspective, both from a FEMA angle as well as from an income tax law. An inbound merger is most efficient. So from a tax wise, it is exempt, whereas from a FEMA angle, so it is approved. It is actually allowed without any approval requirement. But in this case, in Netherlands, Netherlands was not allowing a cross-border merger or a direct merger with an entity which is not within the European Union. So we had a situation wherein so we could not merge this Netherlands entity directly with the Indian entity. So to overcome this, the first step which we have done is so we have moved this Netherlands entity's registered office by way of a re-domiciliation process to a Luxembourg, which is another European country, but that allowed the cross-border merger. That is, it was allowing the outbound merger from Luxembourg to any other country, even to the non-EU country. So step one was to do the re-domiciliation, and then so post re-domiciliation, after a cooling period, the Luxembourg entity would be merged with the Indian entity. Now there could be questions around here, so what are the taxabilities? Now, whether, so on the re-domiciliation, whether there'll be any taxation in Netherlands. As such, so we thought that there is no taxation, but of course it has the taxation. But you have this participation exemption in Netherlands. So if you have, beyond 10% shareholding, etc., you'll get the participation exemption. Basis that, you can take a position that it is not a taxable event. Again, when the merger happens, whether there'll be any Luxembourg implication, there also, there was a cooling period of 12 months. Post which, if the merger is implemented, then again, basis the participation exemption, it will not be taxable over there. From an Indian standpoint, since there's a merger, inbound merger, as such, there should not be any taxability. There could be a question that, when you do the re-domiciliation, whether that will be triggered as a taxation in India, whether that will be treated as a transfer. It is not a straightforward answer, because so we debated this with the councils, tax councils. As such, so the question here is whether on the transfer, whether there is any extinguishment of the shares of the original entity or not. So here, so the council, so we got somewhat, so more inputs from the council in Netherlands also to say that as such, when the re-domiciliation happens, it is not a transfer per se. It is the movement of the registered office from one state to another state. All the shareholders' right, everything remains as is before the re-domiciliation and after the re-domiciliation. And from that perspective, it is not a transfer over there. Basis that the Indian Council also concluded that it should not be a taxable event.
What type of filings are required for relocation as well as the merger? Because if I understand correctly, under FEMA, RBI actually registers the name of the entity, the place of the that is company, and the so if it is not requiring any approval or any such specific filings that are required for relocation and the
Yes. You're right, valid point, ma'am. So from a FEMA regulation, there is a specific FEMA cross-border merger regulation. Okay, so under that regulation, you will have to. There are few conditions which, if you meet, then this could be done without any approval. But post the process of so re-domiciliation is done, you will have to make the filing with the RBI, stating that this is a relocation that has happened, and similarly post the merger, you will have to sort of do. Yes.
is there a format?
I think, so there is no, for the re-domiciliation, there is no specific format. So under the ODA regulations, you give basically a declaration or a letter. Whereas, so for the merger process, you will have to, so file it. There is no specific. Correct. This was a case of, so Aditya Birla, which I was referring earlier. Here, so it's quite a sort of complex structure, so to say, because, they had multiple businesses. So on the left side, you have Aditya Birla Nuvo Limited, which was owning the financial service business, and there are other businesses. And on the right hand, you have GIL, which is owning, there are also some other businesses. Now, they wanted to sort of create a specific entity or a structure only for the financial services business, and all other businesses they wanted to collapse with GIL. So there could be, multiple ways in which, this could have been implemented. But the way they have done it is they first took the ABNL, merged that with GIL. So all the businesses under ABNL moved to GIL. So in terms of, the resultant structure post the merger, step one would be that, GIL will be owning all the businesses along with the shareholding in ABFSL and an indirect shareholding in ABFL. Also, the direct shareholding held of 9.77% by ABNL in ABFL will also move to GIL. Okay. Now, after the first step of, merger, of course, this was done through a composite scheme. So composite scheme is a situation wherein you can do multiple demerger under the same scheme with, specific effective date for each of the steps. So post the merger was implemented, under the scheme, the next one was the demerger, which was demerging the FSB business from the combined entity to ABFSL, that is the subsidiary company of GIL. But along with that, they have also transferred the shareholding of 9.77% of ABFL, because that was now owned by GIL. That was also moved along with the demerger. Now, the tax authorities had raised a question that what you have effectively done is a transfer of the shares. Whether transfer of shares will qualify as an undertaking. Now, there are enough and more ruling to say that so if it is a standalone shareholding, that would not qualify as an undertaking per se. So from that perspective, this was the contention from the tax authorities. But interestingly, in this case, the FSB business, the financial service business, was held by ABNL from 2005. Okay, they have acquired it earlier then, and then they have offered the interest income, etc., on account of that business, and proper returns were filed, which was accepted by the tax authorities. So they had a case. They had a very good case in terms of to say that it is not only the shares of ABFL, that 9.77% which was transferred, but it was transferred along with a larger business, which was the financial service business, and which was offered to taxes in the earlier period also. So because they had a good case in terms of so factual aspect, the tribunal held that as such it should be allowable as a so it should be treated as an undertaking. Otherwise, the contention from the tax authorities was that there is a possibility of so treating this as a one non-tax neutral demerger, in which case it will be taxable in the hands of the transferor entity, that is GIL, which is transferring the shares of ABFL. And secondly, they have also alleged that the shareholders, in this case, post the demerger, ABFSL, that middle entity, would be issuing shares to the promoters and public. So their allegation was that should be subject to deemed dividend application. That is, it should be treated as a dividend distributed by way of the demerger process. Now, both these contentions were rejected by the tribunal, and they have sort of held that it should not be taxable. This is an interesting case. Maybe so I'll take 5 more minutes, then we can wrap it up. So this is a situation wherein typically if you do a acquisition of shares, the underlying assets in the target company, you will not get any cost step up, right? So because you are acquiring the shares, let's assume the target company, in this case company B, which was owning a diagnostic business, let's assume, so the diagnostic business, the book value of the diagnostic business is 10 CR, whereas, the fair value is say 100 CR. And that's the value of the company's B also. Now, if company A is going to acquire the shares of company B, that will be acquired at say 100 CR. But post the acquisition, company in the books of company B, the diagnostic business value would still continue at 10 CR book value only. So as such, they'll not get any additional cost step up in so that they can get any depreciation. Whereas instead of acquisition of shares, if they would have if company had acquired the business per se, which is so the diagnostic business from probably they would have got the cost step up because they would have paid 100 CR to company B, they would have got the business, and in their books they can record this business at 100 CR and claim depreciation on the respective assets. So in order to overcome that, one structure we have thought of was a situation wherein in terms of step one, company A acquires the company B entirely. Post acquisition, we perform a voluntary liquidation of company B. So when you do voluntary liquidation of company B, then post the liquidation, the entire business of company B will be distributed to company A, and thereby they can get the cost step up.
So when company takes up the business of company B, what is the modality of taking up? They will pay money to company B some amount, or how does it work out?
So in step one, when the company A is acquiring shares of company B,
Shares of company.
yeah, it will acquire the shares of company B. So the consideration will be paid to the shareholder of company B. The money will not be. Correct. So that would be a taxable event. See, from a selling shareholder perspective, anyway, this will be a taxable event. Whether you do it in the form of a share purchase, wherein the consideration directly comes to the shareholder, or to a business transfer, wherein the consideration will come to company B. Suppose that you'll have to further remit that money back to the shareholder, etc. But so from a selling shareholder perspective, it was not a bigger question. The question was more from a buyer perspective, whether they'll be able to get a additional depreciation by way of the cost step up. Now, this could also be considered in some of the cases of, say, for example, in case of your real estate developers and all, wherein a real estate developer has some undeveloped sort of land parcel, etc. But assuming that qualifies as an undertaking. In those cases, if you are acquiring the project per se, by way of acquisition of the shares, probably you will not get any cost above in the hands of the acquirer. But post the acquisition, you can sort of, so liquidate this company and then, get the cost above at the acquirer.
That is, company is the holding company of company B.
In step one, it will become a holding company. Correct.
The question of depreciation coming there, how many shares?
No. So see, in step two, when you liquidate, all the businesses along with the assets, liabilities, etc., will move from company B to A. And company B will be sort of, since you have liquidated, it will not be in existence at all.
How to value the amount of dividend?
Which dividend, sir? So in terms of tax implication, when company B is liquidated, you have so basically tax implication definitely will come up. To the extent of accumulated profit, it will be treated as a dividend, and any consideration paid over and above that. So basically, in this case, you will have to establish the value of the business which is being distributed. So assuming, say, in my example, it was 100 CR. So that will continue as a 100 CR worth of amount being distributed. To the extent of accumulated profit, it will be dividend. Over and above that, it will be treated as a capital gain. But so one may ask a question that would there be double taxation or another taxation at the liquidation level? The answer is no, because so initially on step one, company A has already paid 100 CR. Okay, on liquidation, it is getting assets worth 100 CR. And so that is the consideration. And you have an underlying cost of 100 CR. So if you work out the capital gain, ideally it should be zero. In the positive time, I think, so maybe you can go through the other case studies. If you have any specific questions, I can address.
Sir, what is the value of the issue of further issue of share by limited. How to value that?
In the case of, in the merger, demerger case?
No, no. Simple issue of right share. Closely held company.
So sir,
Further share.
yeah, so whenever, so if shares are issued, as such, you will have to issue from a Companies Act perspective,
Yeah.
you have to get a registered valuer's report establishing the value of the shares, fair market value of the shares. And basis that, you will have to issue. Earlier, we used to have this 56(2)(7)(b) issue, wherein, there was a, requirement from a tax law perspective also, which was now done away with. And of course, you have to meet the FEMA conditions. If it is a listed entity, you have to take care of the SEBI regulations, etc. Okay, friends. Any other question? Yes, sir.
Sir, if company A is doing its own business and business of company B, and it has 50% its own business, 50% business of company B. Now company B want to buy the business, get business transfer from A to B, entire business. So in that case, what will be the valuation of business transfer? Will it be calculating my own business? B will say, I'm giving you 50% business. What value should we actually calculate?
No, so you are having, 50%. How you are owning the 50% business?
No, we are not owning 50%. The saying is that company A has a business.
Let's assume business A.
They own customer 50%.
Okay.
50% business comes from company B.
Okay.
So
Okay.
B wants to take the business, entire business. Now, it's
These are A and B are, so unrelated party.
they are related.
They are related party. Sir, it depends. I mean, so if the commercial understanding is that, you want to do it at 11 UAE value itself, which is, book value, you can do so. Whereas, so if it is, if they want to do it at a fair value, then, that is also something possible, in which case you'll have to basically do a DCF valuation to arrive at the value, etc. So commercially speaking, you will have to, between A and B, they'll have to agree that whether they want to make any adjustment for the businesses given by B to A. So in that case, let's assume the fair value comes out to be, say, 1000 CR. Whereas, the book value, 11 UAE value is only, say, 100 CR. So you can do the transaction anywhere between these now. So if you want to make any adjustment, you can do so. But minimum value has to be 100 CR.
Yeah.
Correct.
Okay. Thank you, Mr.
Thank you so much for your patience hearing. Thank you.
Friends, CA Jagannathan has enlightened every aspect towards merger and acquisition and deliberately described key considerations in respect of merger and acquisition. On behalf of CA Study Circle, I request all of you to give a lot of applause. Thank you. Next meeting, 24.